Trade alerts, June 2023. You can take the 7-day trial. It's only $19 at beststockstrategy.com/memberships. Again, it's only $19 for 7 days at beststockstrategy.com/memberships. So June 1st, what we did here was we closed out the 67 and we also closed out the 70. So we used the premium by selling the 67 to buy back one of the 70s. It's a B grade, so the long puts, and bought back one of the 70 strikes. So now I have 5x of the 70. DG is down significantly. The 175 strike is now in the money. Let's give it some time to settle and then see what the best move is. I think this may be the first time this year we've had an in the money position. Then I say that I'm likely going to close out some DG positions. Sometimes a trade goes against you, and while it stings to accept a loss, the most important thing is to never let a loss become large. So here you can see I rolled it down, or at least I tried to. It didn't fill. Closed it out. Closed. Roll down the 165 to 160, extended duration, sold calls to finance it. In all my years of trading, I can count on one hand the number of times a situation like this has occurred. It's best to not get married to the position, cut the losses, and you'll make it back in other trades. I misentered that last trade, so I'm closing it out now. Close out the 170. Rolled the 165 to 160, extended duration, also sold the calls previously to finance the position. New opening trade. Market seems overbought, a low volatility is down tremendously. Picked up $160. S&P up 41. Regarding DG, the trades themselves were very high probability. This type of situation happens around once every 2 to 3 years. Dollar General fell over 25% in the past week, and that's not something that happens often on any stocks that we trade. So why didn't we put forth more effort to roll the position? The answer is that it seems that the underlying fundamentals of the company have changed. In that situation, when there's massive uncertainty, then it's best to simply accept the loss and move on. This is our first losing trade this year, and it doesn't have a large effect on our year-to-date profitability. However, if we started trying to aggressively roll the 175 put by selling more put options, then we're increasing our risk. Now, if DG had been down $15 and was trading at 185 and stabilized around there, then that's a different story. But the violence of the move down means that it's best to take the risk off the table. The immediacy of loss is going to sting. However, over time, as new positions make up for it, then the sting will dissipate. Also, one important experience to share, I remember PayPal was trading around 310, then it fell significantly. And I believe that I sold the 215 put. Then in late 2021, it was trading at 228 and fell to 203. I had a small position in there and felt that I could roll manage the position of profitability. On June 3rd, 2022, that trade actually was profitable, but I didn't close it out and I added more contracts to it. Unfortunately, the fundamentals of the company changed. And by not closing it out when it initially fell from 228 to 223, I turned a minor loss into a larger loss. The key point is if you ever feel that a stock's fundamentals have changed and that it's not the same company as it was when you made the initial trade, then your best bet is to rip off the Band-Aid and move on. Solid opening. Blackstone expires today. SCHD is no longer in the money. Do I regret not being more aggressive and selling calls and rolling down the puts yesterday? Absolutely not. The absolute number one rule when selling options is do not take large losses. Here we bought a SPY put. Market is sold off slightly. Wanted to buy one. I'll buy more when the market continues to go up. But again, lowest volatility and highest complacency in over 3 years. SCHD, rolled the trade. Reduced the size from 5 to 3 and financed it by selling 4x calls. Reduced the strike by $2 as well. This is a proactive roll. Just a few days ago, this position was in the money. It's definitely possible that the 70 strike will expire worthless in 2 weeks, but I felt it's worthwhile to basically neutralize the position, reduce the size, roll it down by $2. It's a B grade because it might be unnecessary. Closing trade with the original. So sold for 27 cents and then bought back for 6. Let's wait until the 43 calls expire. Then we'll open a trade after hours. You can trade SPY and SPX within 15 minutes after closing. New opening trade. Picked up $140. S&P up 61. VIX down 6.7%. We bought a long dated put in SPY. We rolled SCHD. We closed out XLE. We opened up a new trade in SPX June 3rd. Here, I'm just letting people know that I updated the course June 5th. Partial closing trade on BLK. Kept about 85% of the premium. Closing trade for Waste Management. Bought back for 5 cents, sold it for 49. New opening trade, B plus grade. Picked up $153. Rolling trade, rolled DG down by $2.50 and also reduced the expiration. Financed it by selling calls. Hopefully it expires worthless this week. And then we'll focus on the other DG put. Bad luck is part of trading. DG had its worst trading day in 14 years. Need to be able to accept the good and the bad. But even with bad luck, as long as you don't let any trade get out of hand, then you can deal with an occasional bad trade without much stress. It's okay to sell a lot more calls than puts when you have an at the money or in the money position. The reason is that the delta on the puts is much higher, meaning that if the stock rebounds, then you'll make a lot more on the puts than you'll lose on the calls. SPX Strangle picked up $80. S&P down 8. June 6th, we sold 12 DG calls. And then we roll down the position from 160 to 155. The market seems relatively stable. Picked up $60 for the SPX Strangle. S&P up 10, VIX down 5%, and VVIX around even. June 7th, solid opening. We sold puts in TLT, B plus grade. We sold an SPX Strangle, picked up $80, S&P down 16, VIX relatively unchanged. June 8th. Here we bought back DG, and then we sold the 167.5 calls. Insurance is cheap. I bought a SPY put. The market is complacent and discounting future risk. Just like Warren Buffett says, be greedy when others are fearful and fearful when others are greedy. So right now, the market is greedy, so I'm being fearful by buying puts. S&P picked up $120. The market was up 26. VIX was down and VVIX was up. June 9th. Decent opening, S&P up around 10. Here we bought back the DG put and financed it by selling calls. Closing trade for XLE, the original. So here we sold it for 26 and bought it back for 4. New opening trade in SPX. Picked up $140. June 12th, solid opening. Sold Blackstone. June 12th, S&P up 10. We have a lot of positions expiring this week. Here are some of the positions expiring. So I have a $575 profit on BX. Also Berkshire, which we sold for $1,400, but then we rolled it to reduce risk after the market corrected. After the market corrected by 12% in early March, we collected a credit on the roll. Once we get rid of the BRKB, those trades will show around a $2,000 profit. At the moment, with VIX so low, we're not doing many of our usual trades because it's risky to hold long expirations at the moment. New opening trade in SPX Strangle. It's actually a lot of premium. It's like $340 a premium. That's because the VIX spiked up 8.5%. June 13th, new opening trade, B plus grade, S&P up around 12. Closing order. So here, this closed for 10 cents. We sold it for 57. Here for SPX, we picked up $440 a premium. It's a lot. June 14th. S&P. The SPX Strangle picked up $220. Yesterday's Strangle expired worthless for a $440 profit. June 15th, S&P is up around 8. Here, we're picking up almost $600 a premium, $580. S&P up 53, VIX up 4.5%. June 16th, S&P up around 18. Picked up $140 on the Strangle. Yesterday's trade will expire worthless for close to a $600 profit. This Blackstone trade expired worthless for around a $575 profit. Also, the DG calls expired worthless. The market is closed today, June 20th. S&P down around 14, VIX up slightly. New opening trade, small amount of premium, only $40. S&P down 21, VIX down 2%. June 21st. We wanted to roll DG. We had a lot of calls, and the trend for DG has changed once again, and it's bullish. I didn't feel comfortable with the 11 contracts at 170 after watching the price action recently. S&P picked up $60. S&P down 23. June 22nd, S&P down 9, VIX up over 4%. Trend change in DG. Got pinball, doesn't happen often, but in this case it did. Closed out the calls and sold puts. Closing trade, the original. Bought back for 4 cents, sold for 31. Picked up $80 for SPX. We're hedged, so it doesn't really matter which way the market goes. S&P up 16. VIX and VVIX down 2.2%. June 23rd, solid opening. S&P is down over 30. Picked up $100 on the SPX strangle. S&P down 33. June 26th. Picked up almost $100 on LMT. Partial fill, closing trade top. The bottom was the original. Picked up $120 on the SPX strangle. S&P down 20, VIX up 6%. Solid opening, S&P up 12, volatility down. Let's see how the market is trading later. Sold in SPX strangle, picked up $120, S&P up 50. VIX down 3.6%, VVIX down 4.3%. S&P down around 15. VIX is relatively unchanged. Let's see how the market is trading later today. Picked up $80 on the SPX strangle. S&P is up 2, VIX up around 2%. New opening trade on TLT. Picked up $180 on the SPX strangle. S&P up around 20. Volatility mixed. Last Friday, the last trading day of June. And then we made a trade on the SPX strangle, picked up $160. S&P up 54. VIX about even, and VVIX down 2.5%. And that's it. That concludes June 2023. Option trade alerts and option trade signals. You can visit beststockstrategy.com and enroll in the 7-day trial. It's only $19. If you have any questions, leave a comment below and watch the video that's popping up on your screen right now because YouTube believes that you would enjoy it the most.